Good morning, everyone, and welcome back to Morning Markets. I wanted to start today by just discussing a little bit of volatility that we saw in markets over the past 12 hours in Asia trading, all triggered by a comment from one of President Trump's advisors suggesting that the trade deal that was signed with China is no longer intact. So we saw US futures move quite materially on the back of that, and volatility in other asset classes. Lo and behold, normal market conditions were restored when President Trump tweeted to say that indeed the trade deal with China was intact and that there was no change. I mention that because it just serves to highlight how sensitive markets are to news flow and to sentiment at this point in time, and in particular how it relates to the relationship between the US and China. Taking a step back from that, what did we see in asset markets over the past 24 hours? We saw the continued follow through from what we discussed yesterday, the relatively weaker open for Europe and the UK, and that prevailed for most of the day with the Euro Stoxx 50 and the FTSE 100 closing down 60 to 70 basis points. In contrast, we saw the US market perform better than that, with all of the major indices in the US closing in positive territory, and indeed the Nasdaq continuing to push further ahead, with it up 1.1% over the course of the day. Other things that we were looking at, just looking at bond markets, relatively little changed in the sovereign bond markets, and a continuation of the broader trends that we've seen in investment grade, high yield and emerging market debt over the past number of weeks. The main sort of move in sovereign markets yesterday was around Europe, and the continuation of the theme that we've been discussing in the past number of weeks, looking at just how some of the changes in the EU are coming together. And what did we hear yesterday? Well, if you cast your minds back to a couple of weeks ago, we discussed the ruling from the German Constitutional Court and the challenges that presented for the ECB. We heard yesterday from the German finance minister suggesting that an agreement would be reached and it wouldn't be problematic. So that boosted bonds in Europe, and in particular those that are more challenged, to the likes of Italy, where we saw their yields come in and therefore the spread relative to German debt continuing to close. Also coming up in the next couple of hours, we'll get PMI data from the Eurozone and for a number of the countries within that. And that'll give us an indication on how economies continue to recover as they reopen. And I'll comment more on that tomorrow once we've had the chance to look at that in detail. I think the other thing from yesterday that was interesting and certainly worth commenting on is in a piece written by Andrew Bailey, the Bank of England governor, for Bloomberg, an editorial piece. And in that he discusses obviously the challenges that the economy faces and a number of other issues. The one that I wanted just to pull out today and comment ever so briefly on was his thoughts around how to normalise, if you will, the balance sheet of the Bank of England, and how that interplay between normalising the balance sheet plays alongside raising interest rates. And in contrast to what we've maybe heard from Mark Carney when he was governor, what Andrew Bailey has suggested is that the first thing to change should be the size of the balance sheet, so a reduction in the Bank of England's balance sheet before starting to raise interest rates. Now that's very different to the approach that Mark Carney was suggesting only a matter of months ago. So that's something for us, I think, to observe and to think about how that could play out, because what do we know? That post-financial crisis, it's been very difficult for central banks to reduce the scale of the assets on their balance sheet. So the government debt that they're buying, that sits on the central bank balance sheet. And when central banks have suggested that they're going to reduce that, we've typically seen markets react in a negative tone to that. So that's certainly something for us to contemplate and to think about over the coming months and years. Certainly what it does say to me is that interest rates are going to be held at a low level for a considerable period of time. That's it for today. Please join me again tomorrow when we look at the PMI data that comes out from Europe and the UK. Thanks again.